Welcome to our reading on long-lived assets with me, John Bone. Okay, so first learning outcome up, and it asks us to distinguish between the costs that are capitalised and costs expensed in the period in which they're incurred. Okay, so capitalising versus expensing. Now the basic idea is we're applying the matching concept, which is part of accruals. And what the matching concept says is if a cost will generate higher future revenues over a number of periods, that cost should be stored in the balance sheet and then released to match the cost against the revenues it generates. Now, of course, the method for our PP&E is known as depreciation, and the method for our intangible is known as amortizing. And in both cases, what they're doing is they're taking the cost and spreading it over the asset's life through the income statement to match against revenues. So as we can see, capitalizing is all about spreading an asset's costs over multiple periods, the asset's life, okay, whereas expensing simply means put the cost through the income statement in the period in which it's incurred. Now, expense if benefits beyond one period are unlikely or highly uncertain. So in other words, if we incur a cost and it isn't going to lead to higher future benefits, or we're uncertain whether it leads to higher future benefits, then we essentially expense it in the period in which it's incurred. However, if we incur a cost and we know it will lead to higher future benefits, in other words, higher future revenues and therefore higher future earnings, then the matching concept kicks in and we're going to store that cost in the balance sheet and then release the cost over time to match against the earnings it generates. Okay, so let's have a look at our points here. Capitalize if benefits extend over multiple periods. Notice the amount can include additional costs to prepare the asset for use. Now that's a key point. It's saying it's not just the cost of purchasing the asset, it's also the cost of readying the asset for use. So it's all of the costs involved in getting the asset into location and up into working condition. Any additional costs, then they have to be expensed. Now, subsequent expenditure that provides benefits beyond 1 year are capitalized. Subsequent expenditures that do not provide benefits beyond 1 year are expensed. What's this really saying? What happens if you incur a further cost on an asset? So we've got the example here of replacing a roof. Now, if you incur additional costs and that will generate higher benefits in the future, then you've got something to match against. So you're going to add that cost to the original cost and then spread it via depreciation amortization. If you've incurred a cost that isn't going to generate higher future benefits, then you've got nothing to match against, and of course it has to be expensed. Now this situation, capitalized versus expensing, often comes up with maintenance expenditure. Now, if you're incurring maintenance expenditure just to maintain the life of your existing asset, it's not really adding any future benefits and therefore it needs to be expensed. But if you incur a cost that actually improves the earnings potential of the asset, it is leading to higher future benefits and therefore it can be capitalized. But it's certainly a grey area and one you should be aware of. Interest expense. Now, what we're really talking about here is constructing assets or constructing your own assets that you're going to use as part of the infrastructure of the company. Now, the rule essentially here is if you're constructing your own assets that you're going to use for infrastructure, or whether you're constructing an asset that you're going to sell on, i.e. inventory, we are allowed to capitalize interest. Okay. So in other words, the interest cost is deemed to be a component of actually constructing this asset. Now notice under IFRS it says any capitalized interest is reduced by any income on borrowings invested temporarily. So let's imagine you borrowed $10 million to build your head office. And you weren't going to need the full 10 million up front, so you'd taken, let's say, 8 million of it and you'd put it on into an investment account to generate some returns. All it's saying is those returns generated on that 8 million would need to be offset against the interest cost on the full 10 million. Okay, so we can only capitalize the net interest essentially here. So let's turn our attention now to intangible assets. What is an intangible asset? It's an asset with no physical form, something you cannot touch, feel and hold. So identifiable intangibles can be separated and controlled by the firm. In other words, you could sell this off separately if you wanted, whereas unidentifiable intangibles cannot be separated from the firm. Now, most of our intangibles are going to be identifiable, i.e. you could sell them off. patents, royalty agreements, etc. The idea is they do generate expected benefits in the future, and we can reliably measure their cost, and therefore they're deemed to be identifiable. Now, the key unidentifiable intangible asset that we find is goodwill. Here we've got an asset, but it cannot separately be sold. In other words, goodwill typically arises on an acquisition of a subsidiary, and it's essentially the difference between what we pay to acquire the subsidiary and the net assets of that subsidiary after we've made fair market value adjustments to the balance sheet at the date of acquisition. Now, we argue that goodwill essentially is everything that we're paying to get our hands on stuff that is not recorded in the balance sheet. Relationships with customers, relationships with suppliers, relationships with employees, for example, brand names that haven't been capitalized, etc. Now, the idea is, of course, you can't sell these items on. You couldn't sell relationships with customers as a separate asset externally, and therefore it's deemed to be an unidentifiable intangible asset. Now, our LOS is asking us here really to compare the financial reporting of intangibles. And you should be aware that we're really looking at three types here. Purchased, so when we physically go out and buy an intangible. Internally developed, so when we've created the intangible ourselves. And then finally, acquired in a business combination. And of course, goodwill is our classic intangible that has been acquired in a business combination. Now, our intangibles are either finite-lived, meaning they have a fixed life. So you might buy a royalty agreement, and this royalty agreement has a 10-year life. It's got a finite life, in which case we're going to amortize the cost over its life, typically. Spread the cost into the income statement over the life of the asset. Indefinite-lived intangibles. Some intangibles do not have any finite life, but have an infinite life, for example. Now, again, goodwill is an example of this. There's no reason to believe that goodwill will be used up over a finite life. Now, in a situation where you've got an infinite-lived intangible asset, we don't amortize. Amortize is about spreading costs against revenues over the asset's life. Now, if the asset's got an indefinite life, how do you spread against that? Answer, we don't. So we're not going to amortize, but what we are going to do is essentially do annual impairment reviews. Okay, so again, these impairment reviews are now mandatory. You have to do an annual impairment if you're not amortizing. With finite-lived intangibles, we only have to do impairment reviews if we believe that there's some reason to believe that there has been an impairment. So let's have a look at some of the various types of intangible assets that we may encounter in our studies. So let's have a look at some internally developed. Now, typically with our internally developed intangibles, they're largely going to be expensed as they're incurred. Reason is, often, it's too difficult to put a monetary value on these if you've internally generated. So for example, your own brand name. You've internally generated your own brand name over time via advertising, expenditure, etc. Now, the problem is, what is that brand name worth now? How do we put an accurate dollar value on it? So typically with internally generated intangibles, it's too difficult to accurately value, and therefore we don't. Now, there are some exceptions, and we need to be aware of what they are. So here's our exceptions on this slide: research and development and software development costs. Now, we've got to be a bit careful here. Research is really pure R&D, discovering new knowledge and understanding. Both US GAAP and IFRS agree with the treatment. You don't know whether it will lead to a profitable future product, so you don't know if it will generate higher future revenues, higher future earnings, and therefore you don't know whether you should be applying the matching concept. Now, in this scenario where it's uncertain whether something will generate higher earnings, we take the prudent approach and we expense. So both IFRS and US GAAP are going to expense research costs. Now, development costs are all about really translating your research findings into a plan. It's all about essentially developing a product. Now, US GAAP again says we don't know whether developing a product will lead to higher future earnings, and therefore it takes in a prudent approach and expenses product development costs. IFRS, though, is different. IFRS does allow you to capitalize as long as certain criteria are met. Now, be careful. You don't need to know what the criteria are. But broadly speaking, IFRS is going to allow you to capitalize if it looks like the product will be developed and launched and it looks like it will lead to higher future earnings. Then you can capitalize development expenditure under IFRS. So IFRS, research cost expense, development costs may be capitalized. May be capitalized if certain criteria are met. US GAAP, you have to expense both R&D and development expenditure. Now, software development. So we're developing some software for sale here. Now, both IFRS and US GAAP say the same thing here. You need to expense any costs incurred until technological feasibility is established. Once the software is technologically feasible, then any additional costs may be capitalized. Now, the problem here is, number one, what does technological feasibility mean in terms of software? Well, broadly speaking, it means the software does what it was initially designed to do. So in other words, getting your software working, you would have to expense all the costs. Once it does what it's meant to do, any additional costs such as making the user interface pretty, etc., that can be capitalized. Now, problem here is this is going to require judgment. It's going to be very easy to fool maybe auditors who are not necessarily experts on software development. So in other words, you may well have capitalized a load of costs when the software is not technologically feasible, but how essentially would an audit firm spot that? So very difficult. There's a lot of judgment here going into whether a piece of software is technologically feasible. So software developed for sale, be aware. To establish technological feasibility, it has to be expensed. Once feasibility is established, you may capitalize. A lot of judgment. Software developed for internal use. So here you're developing a piece of software and you're going to use it within your business. Now notice IFRS, no difference between software developed for sale and software developed for use. So again, any costs involved in establishing feasibility, expense. Once feasibility is established, capitalized. US GAAP though, here's where the difference lies. Notice US GAAP says any cost, not only once the software is technologically feasible, but any costs in establishing technological feasibility can also be capitalized. So it's all. There's the key word under US GAAP. All software development costs can be capitalized, but remember, it is only in this scenario where the software is for internal use. Okay, so let's look at some purchased intangibles. Now, purchased intangibles are recorded at cost, i.e. what you paid to acquire the intangible. For groups of assets, price paid is allocated based on the fair value of each asset. Okay, now of course a good example of that where you pay an overall price is when you acquire maybe a subsidiary. You pay one price, but it might relate to lots of tangible and intangible assets. So therefore the price needs to be allocated based on the assumed fair value of all of the intangibles and tangible assets. And we can see that more detailed in the intangible assets obtained in an acquisition on this slide. So identifiable assets are recorded at their assumed fair values. Now, of course, then, and this means not only do we look at the fair value of assets already included in the balance sheet, but certain intangibles such as brand names that were not capitalized by the firm because they were internally generated are included in the balance sheet at the date of acquisition. I wouldn't get too worried about that now. We'll see more on these concepts later at level 2. So we look at all the identifiable assets, the assets that we can separately identify, and we record them at fair value. We do exactly the same for liabilities. We then look at the difference between what we paid to acquire the subsidiary and the fair market value of the net assets that we've actually acquired, and the difference, of course, is goodwill. Now again, accountants say this is what you've paid for all of the items not in the balance sheet, relationships with suppliers, customers, employees, and these do help generate higher future earnings, and therefore this is an asset. An analyst might take a more cynical view and simply say goodwill is simply generated because we paid too much to acquire a subsidiary. Now our learning outcome is asking us essentially here to explain and evaluate capitalizing versus expensing and the impact on financial statements. So if we capitalize, remember, we're storing cost in the balance sheet. And if we're storing cost in the balance sheet, our assets, of course, are going to increase. It might be, of course, PP&E if we're looking at land and buildings, machinery. It could be intangibles, of course, if we're looking at things like patents, royalties, etc. So we get an increase in assets. Now, if our assets are higher, equity, of course, has got to be higher to keep it all balancing. If we expense, of course, then rather than appearing in the balance sheet, this item is going through the income statement in the period in which it's incurred. And if it goes through the income statement, it's going to give you lower net income. And if it gives you lower net income, it gives you lower stockholders' equity. So let's actually talk about that. So look at our net income. In the first year, if you capitalize, then you're going to have a higher net income. If you expense, you're going to have a lower net income. Okay, all of the cost will go through the income statement in period one, in the period in which it's incurred if we expense, giving us a much lower income. If we capitalize an item, the only thing we might see in the income statement is maybe one period's worth of depreciation, one period's worth of amortization. So definitely going to see higher net income in the first year under capitalization and lower under expensing. Now, net income in other years, under capitalization, it's going to be lower. We're still feeling the pain of depreciation. Remember, we've spread this cost over the total life of the asset. So we're still getting a hit via depreciation or amortization through our income statement. Whereas if we expense, bang, the cost goes through in year one, but we've got nothing going through in future years. In other words, future periods net income is going to be unaffected, much higher, therefore. Again, when we talk about lower and higher in this slide, we're comparing capitalization versus expensing. Now, income variability. Now, of course, variability in your earnings, variability, we can say volatility when we're really talking about risk. Companies with lower volatility of earnings have lower risk. So notice capitalization is going to give us lower volatility because we're spreading cost over a number of periods. Whereas expensing, much higher volatility in earnings. Bang, the cost goes through in this year, but nothing in subsequent years, giving you a much more volatile pattern of earnings. How does it impact on certain ratios? Return on assets, net income over total assets, return on equity, net income over total equity. Now, of course, if we capitalize, let's think about return on assets, net income over our total assets. If you capitalize, our total assets, of course, are going to be higher. But, of course, again, whilst total assets are higher, net income, of course, is higher in our first year as well. Because we've only got maybe one period of depreciation rather than the entire expense running through the income statement. Now, again, they're both really higher. We'd expect overall our ratio to be high. We'd expect the numerator essentially to dominate the denominator here. In terms of return on equity, net income over stockholders' equity, again, if we capitalize, we've got higher net income, and of course, if we capitalize, we've got higher stockholders' equity as well. Overall, though, in the first years, we're going to expect the ratio to be higher if we capitalize, lower if we expense. Think about it via net income. That's really what I want you to think about here. It's the impact on the numerator that's certainly going to dominate in the short run. Net income much higher if we capitalize, net income much lower because the full cost hits the income statement if we expense. Return on assets and return on equity in other years, well, of course, in later years, notice if we expense, it's going to be higher. Why? Because net income is higher in subsequent years. Why? If you capitalize, you're still feeling the pain of amortization if it's an intangible, or depreciation if it's a tangible fixed asset. In other words, your net income is lower due to depreciation or amortization. If you expensed, all of the costs went through in year one, nothing in subsequent years. So you've got a higher net income figure, and therefore return on assets, return on equity typically improves. Let's have a look at our debt to equity ratio, really. Our leverage ratio is debt over equity, or maybe our debt ratio, debt over assets. Capitalizing versus expensing. No real impact essentially on the debt element here. We're not going to see a big impact on the debt, but of course we've got a higher asset figure and therefore debt to assets is going to decrease. When we look at debt to equity, again, no impact on debt, but of course our equity figure is comparably higher. Okay, remember if you expense, the equity figure is going to be much lower because the full expense has gone through the income statement, giving you lower net income and hence lower retained earnings. So if we capitalize, certainly in the first year, our equity is going to be higher and therefore our leverage is going to be lower. Now, the impact on cash flow from operations and cash flow from investing. If you expense an item, the cash flow element passes through CFO, giving you lower CFO. So if we expense, lower CFO. Whereas if you capitalize, it's treated as adding to your PP&E or your intangibles, and of course those pass through cash flow from investing. So we get a lower CFI. So again, it's just where the cash flow is allocated in the cash flow statement. Expensing, it's going to pass through CFO. Capitalizing, it's going to pass through CFI. Okay, so we now need to describe and calculate different methods of depreciation. We need to describe them and we need to be able to calculate depreciation expenses. So let's have a look at what we really see on a balance sheet. Now, the minimum disclosure on the face of the balance sheet is net book value. Again, sometimes we'll refer to this as carrying value, sometimes book value, sometimes simply balance sheet value, or sometimes net book value. Now, when we look at the net book value, we can actually see it's made up of two components, historic cost and accumulated depreciation. Let's start off with historic cost. It's really the gross cost of actually the piece of plant, property or equipment. So it's actually its purchase price, but remember we don't just stop there. It's actually the cost of getting the asset into its current location and working condition. Once an asset is up and working, any subsequent costs typically are expensed. So it's actually purchase costs, installation costs and transport costs that are being included in our historic cost figure, our gross figure. Accumulated depreciation is simply a running total of the amounts charged to the income statement so far. So a cumulative total of the total amount of depreciation passed through the income statement. So we take our historic cost, deduct accumulated depreciation, and that gives us our net book value or carrying value. Now let's talk about the three methods that we're really asked to be aware of in the exam. Straight line. Key point behind this is the depreciation expense is constant in each year of the asset's life. So we get a constant depreciation expense, very, very common for financial reporting purposes, especially in the US. Accelerated depreciation, here typically we're going to charge more depreciation when the asset is relatively young, and as the asset ages, the amount of depreciation is going to decline. Now, under IFRS, it really says the depreciation method that you use should match the earnings potential of the asset. So if you had an asset that generated very high revenues when it was young, but as the asset aged, the revenues it produced dropped, IFRS would require you to use an accelerated method. US GAAP doesn't mention that, so even if you've got an asset generating high revenues that are expected to decline over its life, you could still get away with straight line. So much more typical, therefore, to see straight line in a US GAAP set of accounts, maybe than IFRS. So there is actually only one accelerated method that we're asked to be able to perform in the exam, and that is the double declining balance method. Units of production, our final method, this is going to depreciate an asset according to how much of its total productive capacity maybe we've consumed so far. So notice the depreciation expense is based on total usage rather than allocating over time. Now, under all three methods, the total depreciation, the cumulative depreciation over the asset's life is going to be identical under all three methods. So really, therefore, our three methods are just affecting the timing of the depreciation. And in particular, note, therefore, with accelerated depreciation, the clue is in the name, you're getting more depreciation earlier on. Okay, so let's have a look at the calculations behind these. Straight line, we take cost, that's of course our historic cost, less salvage value, over the asset's useful economic life. Now, salvage value. This is the estimate of what we believe we'll be able to scrap this asset for or sell this asset on for at the end of its life. How do we know what that is? It's completely hypothetical. It's completely made up by the management of the company. Now, again, it's down to the auditors to ensure that the assumptions that they make are reasonable, but be aware it is a pure assumption. As is the useful economic life, the number of years you're going to use this equipment for, or this machinery for, or this building, for example. Again, it's an estimate by the management of the company. So both salvage value and useful economic life are accounting estimates. And again, it's the role of the auditors, remember, to review the reasonableness of the estimates, but it's the role of the directors to make the estimates themselves. So be aware of the level of subjectivity in these depreciation calculations. Only figure that's not really very subjective is, of course, the cost. So notice what straight line is doing. It's taking cost and deducting salvage value. Now when we take cost and deduct salvage value, what that gives us, this is the, if you like, the cumulative depreciation. This is the cumulative depreciation that we're going to spread over the asset's entire life. We're going to depreciate the asset down from its cost down to its salvage value. And useful economic life is just the number of years. So we're taking the total cumulative depreciation and dividing it by number of years to get a yearly amount. Now, double declining balance method. Here we take cost minus accumulated depreciation. Now, of course, that is just net book value at the start of each year. Oops, start of year. So we're taking net book value coming forward at the beginning of each year, cost minus accumulated depreciation, and we're multiplying that by 2 divided by the asset's useful economic life. Now this 2 here is why we call it double declining balance. There are other methods of declining balance. So for example, you may have heard of MACRS, the Modified Accelerated Cost Recovery System, which is the IRS, the tax authority's official version of depreciation. And they use a 150, in other words, a 1.5 declining balance method. Here in our exam, in financial reporting, the only one we need to worry about is double declining balance. So we take opening net book value at the start of each year times 2 over the asset's useful economic life. Now we have to be very, very careful when we're manually doing the computations here. You need to be careful that you don't depreciate the asset below its salvage value. Now again, if you are using a calculator like the BA2 Plus, you can do depreciation calculations on it. So for example, on the BA2 Plus, if you look above the number 4, you can see the word DEPR, depreciation. And if you use this, the calculator, to calculate depreciation, it will stop depreciating when you hit salvage value. Again, how to use the calculator you can see in our calculator study guide. Now units of production, now notice similar to straight line in the way it starts with cost minus salvage value, in other words the cumulative depreciation. But then it's going to depreciate that or allocate it each year over the number of units used over total capacity. So let's imagine my machine has a capacity to make 100,000 units and I've made 20,000 this year, then units used would be 20,000, total life 100,000. Essentially I'm taking the cumulative depreciation amount and I'm bringing 20% into this year. Okay, so components depreciation, a little awareness I think of component depreciation. I wouldn't worry too much about it. Notice it is required under IFRS, but only permitted under US GAAP. Now let's imagine that you've got a building, okay? So our office building, so we've got a roof, we've got walls, we've got an elevator, we've got air conditioning, etc., carpeting, furniture, fixtures, etc. The list goes on. Now, if we're doing component depreciation, the cost of each of these assets needs to be separately recorded and we need to depreciate each one over its useful economic life. Okay, and that's required under IFRS. Notice, of course, it's only permitted under US GAAP. So what we could do is look at the total cost of the building, including all of these elements, and spread that over the life of the building. Much, much simpler, of course, under US GAAP to do that. So notice, that's why we've said it is seldom used under US GAAP. If someone said, look, you have to you can depreciate each element of your building separately, or just the entire cost in one go, what are you going to choose? You're going to choose the easiest, so you'll go for the entire cost. Whereas IFRS requires each element, each component, each individual asset within the building to be separately reported initially at cost and then depreciated over its own life down to salvage value. More complicated. So into our depreciation example. At the beginning of year one, the firm purchased a new machine for $4,000. So that's our purchase price. The machine has an estimated life of 4 years. So again, management come up with a completely subjective estimate that this machine will last for 4 years. Or 1,000 units of production. The salvage value, again, complete estimation here, is deemed to be $500. Now that means, of course, the total amount of depreciation that we're going to charge on this asset, the original gross historic cost, what we paid for it, 4,000, over it, subtract its salvage value, 500, and that gives us 3,500. That's the total amount of depreciation that needs to be spread over this asset's 4-year life. Now remember, all the different depreciation methods are doing is spreading that slightly differently. Now, notice we're asked for the depreciation expense in year 2, and we're making an assumption as well that the firm produced 400 of units in year 2, so that will be used for the units of production method. So we're going to do straight line, double declining balance, and units of production here. Now our straight line, there you go, 4,000 minus 500, giving us our 3,500, the cumulative amount of depreciation that needs to be spread. We're spreading over 4 years, so 3,500 divided by 4, and that gives us our depreciation expense of £875 every single year. Now, double declining balance, going to be a little bit more complicated. Remember, can be done on the calculator, the BA2+, of course. Year 1, opening net book value. Well, in year 1, we've only just purchased the asset, so we haven't got any accumulated depreciation. So our opening net book value is simply 4,000, notice. That is net book value at the start of the first year. And we're going to allocate the depreciation using the rule 2 times useful economic life. So that gives us 2 quarters. 2 quarters times 4,000. This therefore is year 1 depreciation, 2,000. So when we move into year 2, we've got the 4,000 cost, but we've got accumulated depreciation of 2,000 from year 1. In other words, we've got a net book value coming forward into year 2 of $2,000. $2,000 times 2 over 4, and that gives us, of course, our year 2 depreciation. So $1,000 here. Now notice, of course, that means at the end of year 2, if you're thinking about the carrying value of the asset, $4,000 was the carrying value of the asset. We've now depreciated a total of 2,000 in year 1, 1,000 in year 2, so the net book value at the end of the second year would be 1,000. Now, of course, that means in the remaining years, there's only a further $500 of depreciation to go through to bring the asset down to its salvage value. Be very careful. We're not depreciating it down to 0. We're only depreciating down to salvage value. And that's the danger with the double declining method if you do it manually, that accidentally you over depreciate and take it down below salvage value. Let's look at units of production. Starting point, you'll notice, is identical to straight line, so cost minus salvage value. There's the 3,500. But this time we're allocating it according to how much units produced over its total, the total number of units it can produce in its life. So we've produced 400 units in year 2. Total number of units this asset can produce is 1,000. So in other words, it's produced 40% of its total output. So we'll take 40% of the 3,500, which gives us 1,400. So it could be units produced. If it was a motor vehicle, we could be looking at miles driven, for example, as well. Okay, our next learning outcome is describing how the depreciation methods impact on our financial statements. Now, under straight line, you can see you've typically got a lower depreciation expense compared to accelerated that gives us a higher depreciated expense. Now we have put a little star there because of course under accelerated methods you get more depreciation in the earlier years of the asset, but that depreciation is going to decline over time. So there will be some point when accelerated depreciation drops below straight line depreciation. Remember, over an asset's life, the total depreciation under straight line and accelerated going to be exactly the same. So certainly for in the earlier years of an asset's life, or for a growing firm, implication of a growing firm is it's continually adding to its PP&E, and that means its accelerated depreciation will be maintained at a higher value than its straight line. It's only when a firm stops adding to its assets or slows down the growth in its assets that then the accelerated depreciation will decline and drop eventually below straight line. Now certainly depreciation is an expense, so if straight line gives you a lower depreciation expense in those earlier years, certainly in the earlier years your net income will be higher. The accelerated method, of course, lower net income due to higher depreciation in the early years. Now the other flip side, of course, is the impact in the balance sheet. Lower depreciation means, of course, a higher carrying value. Remember our carrying value, historic cost, less accumulated depreciation. Well, a lower depreciation expense means a lower accumulated depreciation and therefore a higher carrying value for the asset. So under straight line, you've got a higher asset, under accelerated a lower. Final point is equity. I always think of it via net income because, of course, if you've got higher net income, then by default, you've got higher retained earnings in the balance sheet. So straight line, higher net income in the earlier years, higher equity, accelerated lower net income and therefore lower equity. So let's think about a few of our ratios. Return on assets, ROA, net income over total assets, of course. Now, if we do straight line, remember we said essentially our net income is going to be higher. And again, we're comparing straight line to accelerated. So net income is relatively higher compared to accelerated. And total assets are likely to be higher too. Again, implication is that the numerator is likely to dominate this relationship. So overall, we'd expect, therefore, return on assets to be higher under straight line. Return on equity, again, typically net income over equity. If we're looking at straight line, our net income is higher. Our equity, of course, is higher. Higher net income, of course, higher retained earnings. Again, proportionally, the numerator is going to dominate this relationship, giving us a higher return on equity under the straight line method. Turnover ratios, so asset turnover, for example, sales over our assets, or either could be our long-lived assets only, it could be total assets. So again, sales is unaffected, but of course under the straight line method, less depreciation, higher balance sheet carrying value in the earlier years, so higher assets and therefore lower asset turnover. Cash flow, now of course cash flows are identical here. The only cash flow arises when you purchase the asset and you pay the supplier of the asset, and when you physically dispose of it and you receive sales disposal proceeds in. Depreciation, therefore, and amortization of intangibles is a pure non-cash item passing through the income statement. It purely arises from the accruals process, our desire to match costs against future revenues. So, no implication at all on the cash flow statement, regardless of which depreciation method you use. Now, some people say, well, surely accelerated gives me a higher depreciation expense and therefore would give me a lower earnings before tax, meaning I pay less tax. True, if accounting depreciation passed through the tax returns, and it doesn't. And the reason why we don't see accounting depreciation pass through the tax returns is the subjectivity behind the depreciation computations. Number one, you could choose the method. Number two, the assumptions going in terms of salvage value, in terms of useful economic life. Too subjective. In other words, the tax authorities would be too worried that we could use these assumptions to manipulate our depreciation expense. Therefore, essentially, the tax authorities do not allow accounting depreciation to be deducted, and instead they replace it with their own official version of depreciation. And in the US, that is known as MACRS, the Modified Accelerated Cost Recovery System. In the UK, we talk about them being capital allowances. Essentially, what's happening here is the tax authorities are removing the subjectivity. So they eliminate salvage value, they tell you the life of your asset, and therefore subjectivity is removed. They tell you the depreciation method to use, a 150 declining balance method in the US. Okay, still describing the effects on our financial statements. So these are the effects of our estimates. Now remember, we've got useful life and salvage value. Longer useful life, you're spreading the cost over a longer period of time, so depreciation expense is going to decline. Higher salvage value, you've got less to spread over the asset's life. Remember, the total amount we're spreading is the original cost minus salvage value. Higher salvage value, less to spread. So either a longer life or higher salvage value is going to reduce, and that's the key point, it's going to reduce our annual depreciation, of course, in amortization if we're looking at an intangible. Okay, so it's going to reduce the depreciation and therefore increase net income. It also increase assets and equity in the balance sheet. Shorter life. Now, of course, a shorter life or lower salvage value is going to have the flip side. Shorter life means we're spreading over fewer periods, bigger depreciation expense, everything else being equal. Lower salvage value means we have more to spread over the asset's life. Okay, so we're going to get a higher depreciation expense and therefore lower asset values and lower equity in the balance sheet. Now, be aware, these are deemed to be changes in accounting estimates. And of course, what that means is if we change an accounting estimate, we have to disclose that there's been a change in the footnotes, but we do not need to go back and restate prior years. Amortizing intangibles, well, rather similar to depreciation, so nothing particularly that's going to beat you here. You are asked to describe the methods and also calculate an amortization expense. Okay, so it's just the same process here. We're going to spread the cost of an asset to match against higher future earnings. Yes, okay, trying to work out maybe the useful life of an intangible may be more tricky, but it's still an estimate. So intangibles with finite lives, patents, copyright agreements, franchise agreements, that kind of thing, then notice the pattern should match the consumption of benefits. In other words, if this intangible generates higher cash flows, higher earnings whilst it's young and new, then we should use an accelerated method and allocate more cost to the earnings that it generates. If it generates constant earnings over its life, then maybe we should use a straight line approach. An intangible with an indefinite life, now remember, with an indefinite life, we're not really spreading cost over its life because the life is indefinite. Now we see it with intangibles, we also see it with one tangible that has an infinite life as well, and that's land. Land we don't depreciate either. But with an intangible with an indefinite life, classic of course being goodwill, we've got an example here, a trademark that can be just continuously renewed. We do not have to amortize, but instead we do have to do an annual impairment review, and we'll be describing those coming up shortly.